Welcome to the Explainer. You know, we love to take those big, complicated topics and just break them down for you. Today, we're going to demystify two really fundamental trading strategies that let people navigate the markets whether they're going up or down. All right, so let's kick things off with a little puzzle. We all get the basic idea, right? You buy something, its price goes up, you sell it, you make money. Simple. But how in the world can traders actually make a profit when everything is crashing? The answer to that is all about understanding two key ways to play the market, going long and going short. So before we can solve that puzzle, we have to get one core concept down pat, the position. Honestly, just think of it as your bet. It's the side you're on. Are you betting the price of something is going to go up, or are you betting it's going to go down? That simple choice, that's your position. Okay, let's jump right into the first side of that bet. And this is the one you're probably already familiar with, even if you didn't call it this, the long position. The idea here is about as straightforward as it gets. It's that classic principle of investing we all learn from day one. You buy something because you think its value is going to climb over time, and then, hopefully, you sell it later for a nice profit. So when you hear someone say they're going long, all they mean is they're buying something to sell it later at a higher price. This is what we call a bullish view. You're optimistic. You think the market's in an uptrend, making those higher highs and higher lows. Now, the risk here is also pretty simple to grasp. The absolute most you can lose is the money you put in if the price goes all the way to zero. And now, for the other side of the bet. This is where we solve our little puzzle from the beginning. How do you profit when prices are falling? Well, the strategy is called taking a short position. This quote just absolutely nails it. The whole idea of shorting can feel really counterintuitive at first, kind of like a brain teaser. But don't worry, it's an incredibly powerful tool, and we're going to go through it nice and slow, step by step. Okay, this slide shows the mechanics perfectly. Let's walk through it. First, and this is the most important part, you don't own the asset. You borrow it from your broker. Then, step 2, you immediately sell that borrowed thing on the market at its current price. Step 3, you wait. If your prediction is right and the price starts to drop, you get to step 4. You buy that exact same asset back, only now it's cheaper. And finally, step 5, you give the asset back to the broker you borrowed it from. See what happened? The cash that's left over, that difference between the high price you sold it for and the low price you bought it back for, that's your profit. So yeah, a short position is the total opposite of a long one. Your whole goal is to make money from a price drop. This is a bearish view. You think the market is heading down, making lower lows and lower highs. But, and this is a huge but, let's talk risk. Because a price can theoretically keep going up forever, right? That means your potential loss when you're shorting is, well, unlimited. It is for sure a high-stakes play. Now that we've looked at both sides of the coin, let's just put them head to head. That way, the difference becomes totally crystal clear. This table right here is your key takeaway. It brings it all home. If you're going long, you're betting the price goes up. You're a bull. You buy low, you sell high, and your first move is always to buy. If you're going short, you're betting the price goes down. You're a bear. You sell high, buy low, and your first move is to sell something you borrowed. And just remember that risk profile. With a long, your loss is capped. With a short, it's theoretically infinite. It's a perfect mirror image, but the stakes are very different. And there you have it. Once you get your head around both long and short positions, you're really starting to understand how the market works. It's not just about rooting for prices to go up anymore. It's about having a game plan for any direction the market decides to take. So the only question left for you is, which way do you think things are headed next?